You picture it the way everyone pictures it. $1 billion in real estate. Somebody hands you the keys to 1,000 doors and you're free. No boss, no rent due, no $340 sitting and checking with 9 days left before it disappears. You'd never check a price tag again. That's the fantasy. Here's the balance sheet. Say you inherit a portfolio like this tomorrow. 1,000 apartment units spread across 4 cities, 2 office towers in secondary markets, a strip of industrial warehouses leased to a logistics company you've never heard of. On paper, the whole thing is valued at $1 billion. Congratulations, you are now technically a billionaire. Except you can't spend a single dollar of that number. Not today, maybe not this year, because that billion isn't sitting anywhere. It's not in a vault, it's not in a checking account, it's not liquid in any sense a normal person means when they say rich. It's locked inside steel and concrete and 99-year ground leases. It's locked inside tenants who pay on the first of the month, minus the 15% who are always late. It's locked inside a debt structure that, if you actually pull the loan documents, tells a very different story than the word billion implies. Here's what that portfolio actually looks like once you open the file. $600 million in outstanding mortgage debt across the properties, financed at rates that were locked in back when money was still cheap. $220 million in what appraisers call equity value, which is a polite way of saying the difference between what the buildings are worth and what you still owe the bank. The rest, roughly $180 million, is tied up in improvements, deferred maintenance, and the kind of capital expenditures nobody puts in the brochure. New roofs, elevator retrofits, the industrial park's loading docks that need reinforcing before insurance renews the policy. You do not own $1 billion, you own $1 billion machine that generates cash flow, carries debt, depreciates on a schedule the IRS wrote decades before you were born, and requires someone every single month to make a decision about how the money that comes in gets used. That decision is the entire ballgame, and it comes down to one question nobody explains to you when they're busy telling you how impressive the number is. Who's actually holding the asset and under what structure? There are 2 answers. Almost every dollar of institutional real estate wealth on earth sits inside one of them. The first is the public REIT, a real estate investment trust. You've probably owned shares in one without realizing it, tucked inside a retirement account, quietly collecting a dividend twice a year. A REIT takes that billion-dollar portfolio and slices it into shares that trade on an exchange like any stock. Anyone with $40 in a brokerage app can own a sliver of those apartment towers by lunchtime. In exchange for that access to public capital, the REIT signs an agreement with the IRS. It must pay out at least 90% of its taxable income to shareholders every single year as dividends. No exceptions, no quiet years, no holding back cash to buy the next building outright. The money moves through the structure like water through a pipe that was never designed to store anything. The second is the private HoldCo. No ticker symbol, no quarterly earnings call. No analyst on CNBC asking pointed questions about occupancy rates. A holding company owned by a family, a partnership, sometimes a single person who inherited or built the portfolio directly. There is no legal requirement to distribute a single dollar of profit. The owners decide, reinvest it into new acquisitions. Pay down debt early, sit on the cash for 3 years waiting for the right building to come up for sale at the right price. Nobody's forcing a payout schedule. Nobody's forcing transparency either. Same $1 billion in buildings, 2 completely different economic universes. Here's why that difference isn't just paperwork, it's everything. The REIT gives you liquidity. You can sell your position in an afternoon if you need cash for a wedding, an emergency, a bad month. The HoldCo gives you almost none of that. Try selling your stake in a private real estate partnership on a Tuesday afternoon because your car needs a new transmission. It doesn't work that way. Your money is patient whether you feel patient or not. But the HoldCo gives you something the REIT structurally cannot. Control. The freedom to hold an asset for 11 years instead of selling it at the peak of a market cycle because shareholders are demanding returns this quarter. The freedom to refinance instead of sell, to renovate instead of distribute, to run the entire portfolio like a chess game played over decades instead of a scoreboard updated every 90 days. And underneath both of those choices sits a tax code that treats them almost like 2 different countries. What a REIT owes the government and what a HoldCo owes the government, on the exact same buildings generating the exact same rental income, can differ by tens of millions of dollars a year depending entirely on the structure wrapped around the asset. Not the real estate, the wrapper. So here's the real question, the one that actually matters once you get past the fantasy of the number itself. If you had $1 billion in real estate sitting in front of you today and you had to choose the vehicle to hold it in, which one would actually make you wealthier over the next 20 years? The public structure that hands you liquidity and forces discipline through mandatory payouts? Or the private structure that hands you control and lets you play a much longer, much quieter game? That's what we're breaking down, line by line, dollar by dollar. Let's start with the rule that runs the entire REIT machine, because it's not a suggestion. It's not a best practice some consultant recommended in a boardroom. It's federal law. To qualify as a REIT and get the tax treatment that makes the whole structure worth using, a company has to distribute at least 90% of its taxable income to shareholders every single year. Not 90% when times are good. Not 90% unless something better comes along to spend it on. 90%, full stop, written into the tax code since 1960, when Congress decided ordinary people should get access to commercial real estate returns without needing $1 million and a law firm on retainer. Here's what that actually looks like on our billion-dollar portfolio. Say the properties generate $70 million in taxable income this year after operating expenses, interest payments, and depreciation. The REIT is legally required to send at least $63 million of that straight out the door to shareholders. Not reinvested. Not held in reserve for the warehouse roof that's going to need replacing in 18 months. Gone, distributed, sitting in shareholder brokerage accounts before the ink dries on the earnings report. That sounds generous. It sounds like the shareholder-friendly version of capitalism, and it is if you're the one receiving the dividend. But flip it around and look at it from the inside of the company, and that mandatory payout is a leash. It means the REIT can't quietly stockpile cash for 3 years and buy the next apartment complex outright, the way a private owner might. It means almost every dollar of growth has to come from somewhere else entirely, because the operating cash flow is already spoken for the moment it hits the account. So where does the growth money come from? 2 places, and both of them involve someone else's cash. Debt markets and equity markets. If the REIT wants to acquire another $200 million office tower, it either takes out a loan against the existing portfolio, or it issues new shares and sells a piece of the company to raise capital. There's no third option sitting quietly on the balance sheet. This is why REITs are, structurally, some of the most leveraged entities in the entire real estate world. On our $1 billion portfolio, it's completely normal to see $500 to $600 million of that value financed with debt. Not because the managers are reckless, because the payout rule leaves them no other lever to pull. Now here's the trade-off that makes this whole arrangement worth it in the first place. In exchange for giving up almost all retained earnings, the REIT gets something extraordinary from the IRS. It pays no corporate income tax on the income it distributes as long as it stays compliant. Think about what that actually means. A normal corporation gets taxed once at the corporate level, and then again when it pays a dividend to you. Double taxation baked into the system since forever. A REIT skips that first bite entirely. The $63 million distributed to shareholders in our example was never taxed at the corporate level at all. It flows through untouched and then gets taxed once, at the shareholder's individual rate, usually as ordinary income rather than the lower qualified dividend rate stocks like Apple or Coca-Cola enjoy. So the government's deal is basically this. We'll let you skip corporate tax entirely, REIT, but only if you promise to hand almost everything over to your shareholders every year so we can tax it on the other end instead. 1 layer of tax guaranteed versus 0 layers if you hoard it. Congress built a machine that can't sit on cash even if it wanted to. Let's put real numbers on the leverage question, because this is where $1 billion stops being an abstraction. Say our REIT's $1 billion portfolio carries $600 million in mortgage debt at an average rate of 5.5%. That's $33 million a year in interest payments before a single dollar reaches shareholders. Rental income across the 1,000 apartment units, 2 office towers, and industrial warehouses comes in around $95 million annually. Subtract operating expenses, property management, insurance, maintenance, call it $25 million. Subtract that $33 million in interest. You're left with roughly $37 million in taxable income after depreciation deductions bring the number down further from there. 90% of whatever that final taxable figure is has to go out the door as dividends, rain or shine, good year or bad. And here's the part that catches people off guard. If the REIT wants to buy another $150 million property next year to keep growing, it can't just save up. It has to go raise the money, usually by issuing new shares. Say it issues 10 million new shares at $15 each to raise that $150 million. Every existing shareholder's ownership percentage just got smaller. That's dilution. You didn't lose dollars, but your slice of the pie shrank to make room for the new capital. It's how REITs scale past $1 billion into 5 or 10 billion, but it's also why long-term REIT shareholders keep an eye on share count the same way they watch the dividend. Add in the fact that REIT shares trade daily on public markets, and you inherit stock market volatility whether the underlying buildings change in value or not. A recession headline, an interest rate hike, a bad earnings call from a competitor REIT, and the share price can swing 10% in a week, even though the apartment buildings are still 94% occupied and rent checks are still clearing on the first of the month. You own real estate, but you feel it like you own a stock, because legally you do. So who actually wins in this structure? Not the operator chasing generational control. The passive investor. The retiree who wants quarterly income without ever thinking about a leaking roof. The person with $40 who wants a sliver of commercial real estate exposure inside a Roth IRA and the ability to sell it Tuesday afternoon if the car needs a transmission. The REIT trades control and compounding for liquidity and discipline and hands that trade-off straight to whoever's holding the shares. That's the public model, fully lit, fully financed, fully taxed on the back end. Now let's look at what happens when nobody's forcing the payout at all. Now picture the same $1 billion, the same 1,000 apartment units, the same 2 office towers, the same industrial warehouses humming along with tenants paying rent on the first of the month. Same $95 million in rental income. Same $25 million in operating expenses. Same $600 million in debt sitting on the balance sheet. Nothing about the buildings changed. What changed is who owns them, and that one fact rewrites every rule we just walked through. There's no 90% distribution requirement here. Not 80, not 50, not a number written anywhere in the tax code that a private HoldCo has to obey. If the ownership group, let's say a family office that's been compounding real estate for 3 generations, decides to keep every dollar of that $37 million in taxable income inside the company this year, they can. Nobody at the IRS is checking, nobody is filing a complaint. The cash sits, and it works. That's the entire philosophical difference in one sentence. The REIT is built to distribute, the HoldCo is built to retain. And what you do with retained earnings when nobody's forcing your hand out the door is where this structure starts to separate itself completely. Say the HoldCo keeps that $37 million instead of paying it out. Next year, instead of issuing new shares to some public market and diluting every existing owner the way our REIT had to, the HoldCo just writes a check, buys the $150 million property outright, or puts down $40 million and finances the rest privately through a regional bank or an insurance company that's been lending to this family for 15 years. No shareholder vote, no earnings call, no analyst on a conference call asking why guidance missed by 2 cents. Just a decision made in a room with 4 people in it, and the portfolio grows the exact way the ownership wants it to grow on the exact timeline they want. This is where the tax code stops looking like a leash and starts looking like a toolkit. Depreciation, for one, works overtime inside a HoldCo. Commercial real estate depreciates on a set schedule, usually 39 years for the office towers, 27.5 for the apartments, and that's a paper loss the company can use to offset real taxable income even while the properties are appreciating in actual market value. Layer in cost segregation studies, and you can accelerate huge chunks of that depreciation into the first 5 to 7 years of ownership instead of spreading it evenly, front-loading tax savings exactly when the HoldCo needs cash most to reinvest. Then there's the 1031 exchange, the move that lets a private owner sell one property and roll the entire gain into the next one without paying capital gains tax at all, as long as the money keeps moving into like-kind real estate. Our HoldCo sells the older of its 2 office towers for $220 million, one that's fully appreciated and getting expensive to maintain, and instead of handing 30% of that gain to the government the way a normal sale would demand, it rolls the full amount into a new industrial warehouse complex. The tax bill doesn't disappear, it just keeps getting deferred, sometimes for decades, sometimes until the building passes to the next generation and the cost basis resets entirely through inheritance. That's not a loophole. That's Congress's actual intentional policy, and REITs mostly don't bother with it because they're already tax exempt on the distributed income. It's a private ownership tool built for people who plan to hold, not trade. Entity structuring adds another layer entirely. A HoldCo isn't one company, usually. It's a parent entity sitting on top of a dozen separate LLCs, one for each property or property cluster. so that a lawsuit against the apartment complex in one city can't touch the industrial warehouses 2 states away. Liability gets walled off. Losses in one entity can sometimes offset gains in another depending on how the structure is built, and the whole arrangement gets designed by tax attorneys whose entire job is squeezing legal efficiency out of $1 billion of real estate. Nobody's watching from the outside. Now, the money to grow this thing doesn't come from Wall Street. It comes from relationships. Private lenders who finance this family for 20 years. Regional banks that know the properties personally. Joint venture partners, other families or funds, who put in equity alongside the HoldCo for a specific deal and split the upside according to a private agreement nobody outside the room ever reads. No prospectus, no SEC filing, no quarterly disclosure. Raising $150 million happens over a few phone calls and a term sheet, not a roadshow. The cost of all that control is liquidity, and it's a real cost, not a footnote. If you own a piece of this HoldCo and you need $200,000 next Tuesday, you cannot log into an app and sell. There's no market maker, no bid-ask spread, no button. Your ownership is illiquid, sometimes for years, sometimes structurally forever, unless the whole company sells or goes public. That's the price of not answering to anyone. You get total control over reinvestment, and in exchange, your money is locked in the machine, compounding quietly, completely inaccessible until the ownership group decides otherwise. But compounding quietly for 30 years without a mandatory 90% leak every single year is exactly how private real estate fortunes turn $1 billion into $4 or $5 billion inside a single generation. The growth that dividend-paying REIT shareholders never see because their cash got swept out the door annually instead of staying inside the machine. And this structure carries something else REITs can't offer at all: succession. A HoldCo can be built on purpose to pass from a founder to their kids, to their grandkids, with governance rules written into the operating agreement itself, voting structures, buyout provisions, family councils, the whole architecture designed around one family's control lasting 100 years instead of one activist investor's patience lasting one bad quarter. So who wins here? Not the retiree who wants a check every 90 days. The family office. The generational operator who doesn't need liquidity next Tuesday because they weren't planning on selling next Tuesday. This is a machine built for people with a longer time horizon than the market itself. So which one actually wins? Wrong question. It's like asking whether a scalpel beats a sledgehammer. Depends entirely on what you're trying to build, and if you don't know that going in, you'll pick the wrong tool and pay for it in ways that don't show up on a balance sheet for years. Let's put the numbers next to each other, side by side. Same $1 billion, same $95 million in rental income, same $600 million in debt. In the REIT, that $37 million in taxable income gets swept out, 90% minimum, straight to shareholders as dividends, taxed again at the individual level, often at ordinary income rates that can run higher than capital gains. In the HoldCo, that same $37 million can sit, compound, get depreciated against, get rolled into a 1031 exchange, and never touch an individual's tax return until someone actually decides to sell. Run that gap out over 20 years, and you're not talking about a small difference in after-tax return. You're talking about the difference between a portfolio that grew to $2.5 billion and one that grew to $5 billion off the exact same starting properties, because one structure kept leaking cash annually by law and the other one didn't leak at all unless the owners chose to. But return isn't the only column on this spreadsheet, and if you only look at that column, you'll make the expensive mistake before you even realize there was a decision to make. Control is the second column, and it's not close. In the REIT, you own shares, not buildings. You don't get a vote on whether the company buys that $150 million property next door or refinances the industrial warehouses at a worse rate than you'd have accepted yourself. A board decides, an activist investor sometimes pressures that board, and quarterly earnings calls dictate strategy more than any individual owner's 20-year vision ever will. In the HoldCo, control is total. 4 people in a room decide to buy, hold, sell, refinance, or wait, and nobody outside that room has standing to object. That's not a minor perk. That's the entire reason family offices exist in this asset class at all. Liquidity flips the script completely, and this is where a lot of people get seduced by the wrong structure for their actual life. REIT shares trade on an exchange. You want out on a Tuesday afternoon, you're out on a Tuesday afternoon, minus whatever the market's mood happens to be that day. HoldCo ownership, by contrast, is often locked for years, sometimes structurally locked until the entire company sells or goes public, which might be never. If you're 72 years old and living off distributions, illiquid HoldCo equity isn't an investment, it's a trap with good property management. If you're 35 and building a fortune across 4 decades, REIT liquidity is a feature you don't even need, and the mandatory payout is actively working against the compounding you're trying to achieve. Growth potential is really just control and retained earnings wearing a different shirt. The REIT is a machine engineered to distribute, which means every dollar of internal growth capital has to be raised externally. New shares, new debt, both of which come with a cost and a public audience. The HoldCo grows by simply not spending what it earns, buying the next property in cash or with relationship-based financing nobody outside the deal ever hears about. Same billion-dollar starting point, wildly different compounding curve, purely because of what the law requires one structure to do every single year that it never requires the other to do at all. So which one wins? It depends entirely on what you actually want, and this is the part almost nobody sits down and answers honestly before they commit capital. If you want quarterly income, liquidity, and diversification without picking up a phone to negotiate a loan, the REIT wins, full stop. If you want compounding, control, and a structure built to outlive you and hand itself to your grandkids, the HoldCo wins, full stop. The mistake isn't choosing either one. The mistake is choosing based on what your neighbor did or what sounded more sophisticated at a dinner party instead of what your actual time horizon and liquidity needs demand. And here's where it gets interesting, because the biggest players in this game figured out you don't always have to choose just one. That's what an UPREIT is for. A private HoldCo owner, sitting on a fully appreciated property, wants the liquidity and diversification of REIT shares without triggering the massive capital gains bill a straight sale would create. So instead of selling the property, they contribute it into an umbrella partnership REIT in exchange for operating partnership units that can later convert into REIT shares on the owner's own timeline. The tax bill gets deferred the same way a 1031 exchange defers it, except now the family has a bridge into the public market instead of staying locked in private ownership forever. It's the HoldCo's tax advantage married to the REIT's liquidity, and it's exactly how a lot of generational real estate families finally cash out without handing 30% of their life's work to the IRS in a single year. Run it the other direction, and you get private-to-public conversions, where a REIT that's tired of quarterly earnings calls and activist pressure gets taken private by a private equity firm or the founding family itself, buying back the shares, stripping off the public reporting requirements, and going back to operating like a HoldCo, deciding on their own timeline instead of the markets. Blackstone did versions of this repeatedly through the 2010s, taking public real estate companies private specifically to escape the 90% distribution treadmill and redeploy that capital into growth the public markets weren't rewarding fast enough. So here's the actual takeaway, and it's the one thing worth remembering long after you forget every specific number in this video. The structure isn't paperwork sitting behind the real decision. The structure is the strategy. Choosing REIT or HoldCo isn't a formality your lawyer handles after you've already decided what to buy. It's the decision that determines your tax bill, your liquidity, your control, and your compounding curve for the next 30 years before you've even picked the first property. And here's the expensive mistake hiding inside all of this, the one that doesn't show up on a statement until it's too late to undo cheaply. Investors who lock capital into an illiquid HoldCo structure without understanding the multi-year lockup then need that cash for an emergency, a divorce, a medical event, 3 years in, discover there's no button to press and no buyer waiting, and end up selling their stake at a steep discount to a private buyer who knows exactly how desperate they are. That single misjudged structure decision can cost 20–30% of the position's actual value, and it usually surfaces around year 3 or 4, right when life happens and nobody's built in an exit. If you don't want to be the person who finds that out the hard way, there's a book in the description that walks through exactly how to structure real estate ownership before you're a decade deep into a decision you can't reverse. Go check the link.